Hello guys, how are you? Today we will be talking about the current account balance of payments, and in this topic we would cover the current account, which is a record of what a country sells and buys to other countries, and the income that it earns from and pays abroad. So, what is a balance of payments? It is a statement of all transactions made between residents of one country and the rest of the world in a certain period of time. And it consists of three components. It consists of the current account, which would include the trade in goods, which means, since I'm talking about goods, and it was explained before, I'm talking about visible or tangible goods. The second one would include the trade in services. And when I'm talking about services, it means it is invisible. And the third thing would be the primary income. And finally, the secondary income, or I can call it current transfers. Then I have something known as the capital account. So the capital account, it would include payments involving the sale of capital goods or fixed assets such as buildings and machinery. So it's self-explanatory. Capital, remember, it's the factor of production that involves man-made resources. And finally, the balance of payment is made up of the financial account, which is investment flows, including loans and loan repayments. And also it includes the sale of shares. So as we explained previously, in the balance of payments, we have three different types of accounts: the current, the capital, and the financial account. The first thing that I would be explaining is the current account. This is the first type. This one, it includes four components that I need to add with each other in order to come up with the total of the current account. I need to add the trade in goods, and since goods are tangible, it would be known as visible trade. I need to add it with the trade in services, or which is known as invisible trade, with the income, and the income is also now known to be primary income. And finally, I add them with something known as current transfers or secondary income. Now, each component will be explained by itself. When I am talking about exports and imports, we already explained this in previous recordings. Exports, it means when a country is selling its goods and services to other countries. So in other words, it would be receiving money. So it will make a cash inflow to the country. And imports is when my country buys goods and services from other countries. So because they are buying, it means they will have to pay money, so they will have something known as cash outflow. Now, remember, since I'm talking about visible export and visible import, This means I am talking about the trade of goods. And when I am talking about invisible export and invisible import, it means I am talking about the trade of services. So the balance of trade, how can I calculate trade? I calculate trade by finding the difference between exports and imports. Now, if my exports are greater than the imports, this means I would have a trade surplus. So my inflow is more than the outflow. Whereas if I am having the exports less than the imports, I would say that I am facing a trade deficit. All right? This is how I would be calculating the balance of trade, where it means I'm talking about the trade of goods. This is why I said visible exports and visible imports. And when I am to calculate the balance on services, remember services are intangible. So therefore, in the formula, it means I would be talking about the invisible exports and the invisible imports. So I would like you to pause the video and read this slide. This is like a summary of component 1 and 2 in the current account. So I'm talking about the trading goods and services, the visible and invisible trade. Now, since we're done explaining component 1 and 2 in the current account, I have to explain other incomes that are found in the current account. It is, the third one would be the primary income, which it includes two categories of income flow. It is the compensation. So please, I would like you to write that down. Compensation of employees, which means I'm talking about outflow, since I would have to pay them money. Also, it can include investment income, which is inflow. Remember, outflow income is known to be debit because it is paid out to residents of other countries, and inflow income, it is also known to be credit because it is received from or earned overseas by residents. Okay, so as a summary, what's included in the primary income? It can include wages, it could include rent and investment incomes received from non-residents, and if this is the case, I would put it under credit. And also it could include the debit, which is wages, again, rent, and investment incomes that are paid to non-residents. Now, how can I calculate the balance of primary income? So it's always the expenditure and the revenue, right? So I need to subtract here at that point. I would be subtracting credits minus the debits. This is how I will calculate the balance of primary income. Finally, the fourth component, it would be secondary income, or I can also call it current transfers. What does the current transfer include? It includes pensions, social contributions, welfare payments, taxes collected from wages, and gifts or foreign aid or donations. So again, I need to calculate it by finding the balance of secondary income, or I can call it net current transfers. How do I calculate it? Same as the primary income, I need to do credits minus debits. Okay, so I just need you to remember that this is, when I'm talking about current transfers, it is unlike incomes that are received from the sale of exports or from the use of the factors of production overseas. It is simply transfers of money or benefits between residents and non-residents. So they are not payments for goods or services or for the use of factor resources. All right? So as a summary, what is the balance of payments current account? You need to know that it records how well or how badly a national economy is doing in international trade in goods and services. So it is all the monetary transactions between a country and the rest of the world. It is being recorded here in the balance of payments. So as we said before, it includes the four components, which means I'm talking about the balance of trade, which is the goods. I'm talking about the balance on services, which means I'm talking about invisible trade. And I need to add it with the balance on income, which was explained before. And finally, with the net current transfers, which was also explained before. Now, the only new thing would be, what do we mean by credits and debits? As you know, credits, it means money received from overseas. So it is happening when I was selling them a product and I received money. So this is considered to be cash inflow or exports. And on the other hand, the debits would be the outflow or the imports. So I need you to know that when we are going to calculate it, as you will see in this slide, how do we calculate it? Each period, government statisticians will add up all the credits on the current account and all the debits. Deducting the sum of debits from the sum of credits will give the final balance on the current account. You will be receiving a current account surplus if the credits exceed the debits. So what does this mean? This means that the country has earned more from trade, primary incomes, and transfer than it has lost in payments for imports, primary incomes, and transfers to residents of other countries. You need to know that the current account surplus therefore increases the gross national income of an economy. So this is something good. Whereas on the other hand, you guys, I can have something called a current account deficit. And deficit, it means it would be negative. So at that point, the credits were less than the debits in the current account balance, okay? This means the country has paid out more for the imports, the primary incomes, and transfers to residents of other countries than it has received from them in the same period of time. Now, a current account deficit, therefore, it reduces the gross national income of a country. So this is definitely something bad. Now, as you can see, this is a numerical example. What we did here, we added the balance of trade, and I will denote it by A. And I added with the balance on services, which is denoted by B. And then I have the balance on income denoted by C, and the net current transfers finally, which is denoted by a D. So as you can see, when I add all these four components together, I am finding out the current account balance. So governments do that in order to check how good or bad a country is doing in terms of trade and other transactions. Now remember, when I have a trade imbalance, whether it was a surplus or a deficit, this would lead to problems in an economy. Therefore, let's see here what are the problems that we will face from either having a surplus or a deficit. I will start off with a trade surplus, and remember, it means that the exports were greater than the imports at that point. So it is a problem because other countries may put political and economic pressure on the government to reduce the trade surplus so they can reduce their trade deficits. Because if one country is facing a surplus, another country will be having a deficit. The second problem that might occur would be the boost in income from trade. Remember, everyone would be having more money. It might lead to demand pull inflation when it is spent in the economy. And finally, one problem could be when we are facing a surplus, the value of the currency will rise on the foreign exchange market and it will stay high. This will increase the price of our exports overseas and sales could be lost. So it would lead to a trade deficit on the long run. So I will write down the points. It might be political pressure from other countries. The second point that we discussed was we said it might lead to demand pull inflation. And finally, we said on the foreign exchange market, our value of our currency would be high. And remember, when our currency is appreciating against others, this would be a problem because our exports will be more expensive and countries will stop trading from us. Now, if I am having a deficit, it means that we are importing much more than what we are exporting. So it is a problem, first because it may be the result of an industrial decline in the economy. So our industries are not operating to the maximum. They are not producing goods that we can export. Therefore, we had to import much more than what we usually export. So we would call that industrial decline in the economy. The second reason would be it means more income is leaving the economy, leaving less to spend on domestic goods and services. So less production on local or domestic goods and services. And the third one would be that the value of our currency will fall on the foreign exchange market, making imports much more expensive. So our currency is depreciating against others. Therefore, imports which we rely on would become more expensive. And finally, the fourth problem would be to pay for recurrent deficits. A country may have to borrow from overseas. I need to pay for whatever I'm importing and I don't have money. How would I be getting the money? I would have to borrow from other countries. And remember, when I am borrowing, I would have to pay interest rates, very high interest rates. And this, guys, it will increase the public debt and the total interest charges in the economy. So our public debt will increase. Since we have a problem, as we know, for every problem there will be a solution. So I need to figure out ways of how to correct the trade imbalance. When we are having a trade deficit, what can a government do? The first thing would be it could do nothing. It could do nothing at all because the exchange rate will depreciate, making imports more expensive. So, since the imports are more expensive, our demand would fall. So let me write it down. Imports are expensive, so the demand will fall, but exports are cheaper to buy, so overseas demand will rise. So they believe the problem will fix itself. The second one would be to use a contractionary fiscal policy. How? It is by either increasing taxes and cutting down public spending, so government spending, and this will reduce the total demand, so the aggregate demand for imports, it will be less. The third way would be to raise the interest rate. What will this do? It will attract an inflow of savings from overseas. So people from outside would be interested in saving their money in our country since they will be receiving higher interest rate. And this will reduce borrowing by consumers because they will end up paying much more on the loan that they will take. So they will decide to not take a loan. And this will help correct the trade deficit. Finally, a government may use trade barriers in order to restrict imported goods. Now, how can a government reduce a trade surplus? Again, because we said this would be a problem and we need to correct it. The first way would be do nothing at all, which is because the exchange rate will appreciate, making imports cheaper, and therefore the demand will rise. But exports will become more expensive to buy, so the overseas demand will fall here. The second way would be to use an expansionary fiscal policy. And why would I want to use an expansionary fiscal policy? Because this would increase demand for imports through tax decrease or cuts and increase in public spending. And the third one would be lower interest rates, and this will encourage investors to move their saving from their savings overseas and also encourage more spending on imports by reducing the cost of borrowing. And finally, it would be removing trade barriers. And that way, they will not be restricting the imported goods. So they will be importing more. And this is how they will be achieving a trade balance. So remember the macro objectives of any government in the world. One of the main macroeconomic objectives would to achieve trade balance. And that would be it. Finally, this is like a summary of this lesson. When I am talking about the balance of payments of a country, you need to know that it records all flows of money into and out of an economy in a given period. This period, it could be a month or a year. And you need to know that it consists of three main components. The current account, as we explained, it has payments for visible and invisible imports and exports, plus the net income flows and transfers. So it has the four components that we explained. And the capital account, it will include the sale of capital goods, such as buildings and machinery. And finally, the financial account, which shows us the investment flows, which includes loans and loan repayments and the sale of shares. Thank you for listening. And as an exit ticket for the lesson, You can choose any of the 4 questions and leave a comment in the comment section under the video. I hope you liked the lesson. Have a lovely day.